Hey everybody, can you all hear me all right?
Yes, sir.
Yes, sir.
I'm gonna give people about one more minute before starting. We got a decent amount of people in here right now, but I want to see if we can get a few more in. All right, before I get started, always got to remind everybody, please try to mute your mics while I'm doing the demo. This one's going to be a little bit longer. I don't know if you attended my demo last week on 529s versus UTMAs, but it'll be probably about 5 to 10 minutes longer than that one. So please do your best to keep your mics muted during the demo. And then if one of you could just let me know if you can see the screen all right.
We can see it.
Sweet. Awesome. I'm gonna go ahead and get started. So thank you all for coming tonight. This was actually the first presentation I did a month ago, but I accidentally didn't hit the record button last month. Let me make sure before I even get started again, let me make sure I am recording. Your screen sharing is paused. Now we hit it. Okay. Yeah, so I didn't record this last month, so I wanted to give people an opportunity to get into this presentation again, and so I can record for others going forward with this. So this is going to be specifically index fund investing. And just a brief little introduction to who I am. I always like to give people a little background of who I am before they start listening to me. So I go by the Wealth Dad on social media. I'm on Instagram and Twitter. I'm a self-taught investor. I'm 28. I started investing when I got out of college, which is around 22 or 23. And my very first, my starting salary wasn't that high. I was only making $35,000 a year. My very first contribution was like a $57 contribution to my 401k. And me and my wife have slowly been building over the past 6 years on top of that portfolio. So I'm a husband, a father. I do have one son and a daughter on the way. We have a UTMA account for my son, and we're also going to set up a UTMA for my daughter when she's born. I've also written a 100-page ebook on index fund investing that sold over 2,000 copies already. And it's pretty much shows people how to successfully invest in index funds over the long term and how to build and manage their own portfolio. Why I list my occupation, I just like to show people that you don't necessarily have to be a finance expert to succeed in the stock market and investing in it. You can be a teacher, you can be a fireman, you can be a cop, whatever the case may be. You just kind of have to find a strategy that fits best for you and just be consistent with it. With my research and my reading, I came to the conclusion that long-term investing in index funds was my route. So that's pretty much what I do on a daily, weekly, yearly basis. So a little bit about my skin in the game. So, I'm kind of serious about index funds. So this is our total family portfolio between me and my wife, all of our investment accounts. This is our 401ks, Roth IRAs, our brokerage account, all mixed into one. We recently just topped $300,000 invested. Last Friday, I think we hit that milestone. And as you can see on this chart on the left, this is essentially when we first created this account with Personal Capital. But you see how compound interest has started to take effect. It took us about 4 years to get to that first 100,000. And then it took about a year and a half to get to the next 200,000. Then it only took 6 months to get from 200,000 to 300,000. So the wealth snowball is really starting to pick up effect now. So you always hear people say after that, saving up the first 100,000 is the hardest, but then after that, it gets a little bit easier because compounding starts to help you out a little bit. And then on the right here is all of the funds that we own. We own 5 funds currently, and this has been their investment performance over these past 5 years. So we've actually slightly outperformed the S&P 500. This wasn't even necessarily by design. We weren't looking to beat the market. We were just very fortunate to have a nice combination of international, US, and then a information technology ETF. That's that first one right here, GT. That's performed extremely well since we bought in a year ago. I think it's outpaced the market by like 10%. And that's where you kind of on our chart where we slightly outperformed. So like I said, I just like to show people before I start going into index funds that we do have skin in the game in this, and that we've been doing this for years now and definitely believe in this philosophy. So what I'm going to go over tonight is a couple basics on index funds. First, we're going to go over what exactly a stock market index is before explaining what index funds and ETFs are. Then there's going to be a little bit difference between what is the difference between index investing versus investing in actively managed funds. And when I say actively managed, think of like ARK, one of the hot funds right now that's been crushing like the S&P 500. We'll use ARK as an example in this one. Also, we'll talk about fees and their effect on a portfolio over time. We'll talk about the importance of getting time in the market starting as soon as you can. And then we'll talk a little bit about target date retirement funds, which is what's in a lot of your work-sponsored retirement plans like 401ks, TSP, if you're in the military or the federal government. Some of your state plans as well will have these. And then at the end, we'll talk about managing that portfolio over time. So how do you rebalance these portfolios on an annual basis? And then once you're actually retired, how much of that money can you then withdraw so that you don't run out before essentially you pass? So making sure that you have that consistent, steady stream of income for the rest of your life. So stock market index, what is it? Essentially, it's just a collection of stocks that represent either the stock market as a whole or a smaller segment of the stock market. So a couple examples on the right of a stock market index. A lot of big ones that you've maybe heard before. The S&P 500 tracks the 500 largest US companies in the United States. The NASDAQ tracks 3,000 stocks that are traded on the NASDAQ exchange. And you've also probably heard of the ETF QQQ. That tracks the NASDAQ 100, which are essentially the 100 largestly traded stocks on the NASDAQ, primarily technology companies. And then also the Russell 2000. It's a good benchmark to track US small businesses. You've also heard of probably the Dow before. A couple international ones are the FTSE 100. That's the United Kingdom index. The Nikkei 225, that's Japan. But what essentially a stock market index is just a collection of stocks that represent a stock market. So anytime you hear in the news, how's the market doing today? That's what they're referring to. They're just referring to a broad stock market index that's tracking a large segment of the stock market. So with knowing that, what a stock market index is, let's talk about a little bit about market capitalization before we go into index funds and ETFs. How is it? Sometimes you may have heard this is a large cap stock, this is a mid cap stock, this is a small cap stock. What does that mean? It's just essentially the size of the company, the financial size of the company, right? So a large cap stock is a company with a market cap of 10 billion or greater. A mid cap stock is between 2 billion and 10 billion. And small cap stocks are 300 million to 2 billion in size. On the right, you'll see just a kind of an example I illustrated using a fake company. I'll say Wealth Dad Inc. This is a company that I own. So how you calculate my market cap is you essentially will take the total shares outstanding that's offered. So in my case, there's 5 million shares that are offered to the public. And the price per share is $100 for each of those shares. So to calculate that is you'll take that 5 million right here at the bottom and then times it by 100 for the share price, and you're going to get 500 million. So my market cap for Wealth Dad Inc. is $500 million. If you translate that back to the left, that means I fall under a small cap company. I'm a small cap stock. That's what I'm traded as. So I would fit into essentially the Russell 2000. I'm one of those small cap stocks that would fit in one of those tracked in that small cap index. So what are index funds and ETFs? Now that we know what a stock market index is, and that it's just a collection of stocks that make up an index, a passively managed index fund or an ETF essentially just tracks that stock market index. So if you have an S&P 500 ETF, all it's doing is buying the exact same 500 companies that make up the S&P 500. So you're mirroring that stock market index. You're going to do no better than it. You're going to do no worse. You're just going to do exactly how it does. So if you're tracking the S&P 500 with an S&P 500 ETF, and the S&P 500 goes up 10% a year, then your investment's going to go up 10% a year. If it falls 8% the next year, your investment's going to fall 8% the next year. So you're doing exactly what the market index that you're tracking is doing. So what are some of the similarities between index funds and ETFs? Because they're often used kind of one and the same. So the similarities are their instant diversification. They're going to track hundreds to thousands of stocks based off of what your whatever fund that you are tracking. If you're going to be a total stock market index fund or ETF, you're instantly diversified to over 3,000 stocks in the United States. And they're all predominantly low cost. We'll go into a little demo detail about expense ratios, but it costs almost nothing in annual management fees to own these. Since you're not paying a fund manager to beat the index like you would with ARK, you're going to be pretty much paying rock bottom low costs to track the index. And they have a great long-term track record against these actively managed mutual funds, primarily because of these fees that you save in over time. Some of the differences between index funds and ETFs is primarily how you just buy and sell them, and then the minimums. So index funds, if you ever place a purchase for an index fund, let's use Vanguard. VTSAX is a very big fund that we hear a lot in the Discord, and then maybe also on Twitter. Anytime you buy an index mutual fund, the purchase is not going to be completed until after the market closes. So you'll never see that order closed until pretty much the next morning. So if I went in today and bought $1,000 worth of VTSAX, I'm not going to see that order completed essentially until I wake up tomorrow morning and see that it happened overnight, and then it essentially bought my shares at whatever the closing price was. ETFs, on the other hand, trade throughout the day like stocks. So you can set limit orders, different kind of parameters on what the price is that you want to buy. But that's just kind of the little difference in between how you can buy and sell them. You can also, like I said, if you sell an ETF, you can sell it throughout the day. An index fund, you have to wait to the end of the day. And then the minimums. ETFs, you have to have the cost of the ETF share price. Although you can buy fractional shares these days, but primarily we'll speak for the share price. If an S&P 500 ETF costs $100, you're going to need that 100 to buy in certain brokerages. For index funds, you're generally going to have an investment minimum. Vanguard has the highest ones. They're normally about $3,000 a fund. They're the highest ones, though. I think Fidelity and Schwab are close to $1, maybe even $0 in most instances now. So you just have to kind of keep a note on those minimums, and I'll break that down in a video later as well, how to find those minimums. So the difference between indexing and actively managed funds. The primary difference is index funds and ETFs track a stock market index, and the actively managed mutual fund tries to beat the index. So on the right here, you kind of see a little breakdown of their strategies, the objectives, their fees, and things like that. Take a notice on the expense ratio for both of them. And I'm going to speak as a US investor. So if there's any like Canadian or UK listeners right now, your fees might be a little different. So just take that in mind. But if you're a US investor and you're looking at an index fund, you generally want to have a fee that's less than 0.5. Fidelity even recently launched a zero fee index funds this past year, which are 0% now, which is great. And then the expense ratios for actively managed funds are closer to 0.5% to 1% total. So ARK, I think, is 0.75. We'll take a look. And international funds are always going to be a little bit more expensive for actively managed and index funds. Tax efficiency index funds are definitely a lot more tax efficient than an actively managed fund because there's going to be less selling throughout the year. Actively managed funds can pretty much sell stocks and holdings whenever they want to, and then those sales and profits are passed back on to you as the shareholder. So you'll have to account for those capital gains taxes throughout the year. So if you're holding investments within a taxable brokerage account, index funds and ETFs are a great investment to use because of the low fees and those less taxable gains for the buy and hold strategy. So breaking down the cost of fees a little bit more in regard to expense ratios, we have two examples here of two different investors, Amber and Tony. Both are investing $500 a month into a Roth IRA. One chooses Vanguard, one chooses Fidelity. The main difference is Amber invests in a low-cost S&P 500 index fund, and Tony invests in an actively managed fund. Amber's paying almost next to nothing in expense ratio fees, but Tony's paying 1%. Tony's also hiring a financial advisor to manage that account, and that financial advisor also charges 0.5% in their own management fees. So under both those scenarios, both Amber and Tony are investing for about 35 years, from 25 to 60. And you'll see at the bottom the difference in their earnings at the end of the year. Now let's break their earnings down and see how they lost, or how Tony lost so much more in fees than Amber. So take a look at the chart on the right as I'm kind of talking through this. So the key differences between Amber and Tony's strategy was Tony picked an actively managed mutual fund with a higher expense ratio, and Tony used an investment advisor. So you'll see that Amber had or let's use Tony's example. Tony actually had a higher annual return than Amber. Their fund manager and or their actively managed fund beat the index over the long term. So Tony actually got a higher return every year. So it looks like on face value, he did better. But when you account the fees on the fund and the advisor fees, 1% expense ratio, 0.5% advisor fees, Tony's real return was actually 7% a year when you account for fees. Amber's was 7.96 because it was just the expense ratio was 0.04, subtract that from 8, 7.96. So you see Amber lost almost next to nothing in fees throughout the long term. And Tony lost close to $250,000 just in fees, even though his investments beat the index over the long term. Amber only lost a little bit over $10,000 in fees over 35 years. So these expense ratios, although that they can seem maybe small when you first read them. So if you see maybe in your 401ks that their fees are like 0.4, 0.6, 0.7, that may seem small in the short term at face value, but the longer you're investing, just like with an investment, compound interest is going to work against you with fees. Those fees are going to add up and take from your return, and it's just going to line the pockets of your investment advisor, the funds and things like that, and instead of you. So fees are extremely important to look at when you're investing in index funds and actively managed mutual funds. So let's do a little live demo real quick. How do we find our fees? We'll use an example from Vanguard, Schwab, and Fidelity, and I'll look up ARK. So there's two primary ways. I'm going to just Google VTSAX. That's the Vanguard Total Stock Market Index Fund. I'm sorry if this screen's a little small for you guys, but here's the first way you can do it. Google will give you a kind of little market breakdown of the fund. And on the bottom right, you'll see this expense ratio field right here. That's going to give you what that fee is. It's going to be 0.04. So you can find it quickly just on Google, or you can essentially go to the first link, which is going to be Vanguard's page. And it's going to give you a breakdown of the fund. So you'll have price and performance, but you want to look at that fees section. Always look for fees. Go to the fees, and then it'll give you your expenses right here. Right here, expense ratio 0.04. So that's one way you can find it, or that's the second way you can find it. Now let's look up ARK. Like I said, I'm not going to argue with ARK's return. I just want to show kind of the fees, how to find ARK's fees. They don't have the expense ratio on their chart on the Google page. So I'm going to click on their funds page. And theirs is going to look a little different. Every page is a little different. But if you scroll, they'll generally give you a details. Here we go. Fund details. This is the first section. Expense ratio. Right here, 0.75. So VTSAX was 0.04. ARCS is 0.75 for this fund. So what this means is ARC has to beat essentially the index by 0.75 every year. So if the index returns 10%, they have to return 10.75% to get the same return, because that fee is going to take off of their total return. So that's how you're going to find your fees in that route. I'll also go to Fidelity real quick to show you how you would find it there. Yeah, theirs is in the same Google, expense ratio 0.15. And I think their user interface is a little bit better than Vanguard's as well. I'm not sure if theirs says, okay, so fees and distribution, or they have another kind of details tab too, expense ratio 0.01. You can click here for fees and distributions, and it'll lay it out right there as well. Let's use Schwab now, SWTSX. So same route, they have the expense ratio on the Google little page right here. And then their UI is probably the best in my opinion. I actually heard they have the best mobile app as well out of the three. It's definitely not Vanguard. Fund details, portfolio distributions. Theirs is right at the beginning. So their fees and minimums are right up front as well, 0.03. So that's how you're going to find your fund, the fees on your funds and your investments as well. And I advise you to do this with your 401ks and your 403bs as well. If you can't find the expense ratios on your funds in your retirement plans, find that stock ticker symbol to what that fund is and then Google it. You'll be able to find the expense ratio through there and go to the company to find exactly what that fee is going to be. So that's just a quick little demo on how you can find fees and save yourself before kind of investing in any of these funds. So next topic, time in the market, why it's so important. We always hear it's so important to start early because compounding is your best friend. And that's completely true. So another scenario, two different investors, Sally and Sean, both started investing at two different times in their life. Sally was much earlier at 22 and Sean started at 32, a decade later. So Sally had an entire 10 years head start on Sean. They both invested the same amount, $500 a month, into an S&P 500 index fund inside their Roth IRA, and both returned 8% a year. But if you see what that 10-year difference was, Sally's account grew close to 1.25 million, almost 1.5 million, to where Sean's was at about 628,000. Sally pretty much more than doubled Sean's final portfolio value just by starting 10 years ahead of time. And that's the power of compound interest and starting as early as you can, because that money is going to keep growing and growing and growing. I think if you've heard a lot about Warren Buffett's wealth, it's something like 95% of his wealth, or some ridiculous amount of his wealth, was actually created after like his 70th birthday. Because once compounding gets to a large enough amounts, it's almost mind-blowing how quickly money just starts doubling over time. And let's talk about the primary reason again. What is compound interest? I found a great definition from a Forbes article by Kate Ashford. I'm going to give her credit in this one. But she says, with compound interest, you're not just earning interest on your principal balance. Even your interest earns interest. Compound interest is when you add the earned interest back into your principal balance, which then earns you even more interest, compounding your returns. So it's essentially like interest earning interest on interest on interest. And on the right, you're going to see a 20-year period of just essentially a starting initial investment of $1,000 that earns 10% a year. Just a hypothetical example that we'll use for this scenario, but 10% is an easy number. So if you see that first year, they earn $100 in interest off of that $1,000 investment. So the next year they're starting off at $1,100. But this time they're earning $100 or $110, because not only are they earning that 10% on the initial principal, but they're earning that 10% on the interest they earned. So they earned even more interest in year two. Year three, they're earning 121, then 133, then 146. And if you go all the way down to year 20, they earned over $600 in just interest. And this is all stemming from an initial $1,000 investment that was allowed to grow and compound over time. So as that interest, as you see, keeps growing on top of these principal balances, the interest earned every year keeps growing as well. And this is how you see people creating crazy amounts of wealth, because they let their investments grow for 10 years, for 20 years, for 30 years, for 40 years. And their money is essentially just a printing machine at that point. So definitely don't take compound interest for granted. It is going to be your best friend in the investing world. Besides your investments that you pick, letting compound interest pretty much work its power is going to be your main benefit in investing. As you saw in my example in the beginning, how we got to 300,000. When we got to this last $100,000 mark, it only took 6 months, where the first 100,000 took 4 years. So it really does start to pick up as you gain steam. Target date retirement funds. These are the primary retirement routes that a lot of your companies are auto enrolling you in within your 401ks, 403bs, 457s. I think the TSP has these options now as well. But they are essentially just a fund of funds. It's an ultimate one-stop shop for an investor who doesn't want to manage their money, but wants it to grow essentially in a passively indexed way. So most target date funds are made up of at least 4 funds. I'm using Vanguard as an example here. You're going to have representation from the US stock market, international stock markets, and then also the US bond market and international bond markets. And what these are essentially designed to do is they will keep you in a more aggressive, risky portfolio balance the younger that you are. And as you grow older and get closer to retirement, it's automatically going to rebalance your portfolio into a more conservative allocation. So it's going to take it's going to take more from your stocks and go more towards bonds. And you're not going to have to worry about this. So it's kind of the benefit. The fund is going to automatically do it for you, so you don't have to do the work in that. They're going to charge a little bit more in fees for that management, but Vanguard and Schwab have great low-cost options, which it's not that big a deal. So you'll see, I use 2 examples down here. With target date retirement funds, if you're going to go this route, you want to pick the target date retirement fund that corresponds to the year that you expect to retire. So I'm going to use an average retirement age of 60 as an example. So if a 25-year-old, let's say fresh kind of college grad getting started, wants to invest in a fund, they want to do the math on how long it's going to take to retire. So 60 minus 25 is 35 years. So they want to be in a fund that's 35 years from now. So that's going to be the target date 2055 fund. For a different person, like a mid-career or a later career person at 45 who's going to retire in about 20 years, they want a 2045 fund. So you're essentially just lining up that retirement year that you expect to finally leave the workforce. Make sure you invest in that fund, so you have the right kind of risk tolerance and balance that you're going to want. So what makes up a TDF? We'll do another little live demo so you can kind of see what's in your target funds. So you can just Google, if you wanted to play around and if you're not in a fund, just Google Vanguard and just insert the year that you want to look at. I'll do Vanguard 2055. So you'll see here again, we have the chart. You're going to see the expense ratio, 0.15. So I told you it's a little bit more expensive than just like an S&P 500 index fund, but that's still pretty low cost in the world of investing. If you're just this is what I would use essentially if I didn't want to pay a fund manager. Like if you were to go to your local bank or whoever family investment advisor who charges you fees, instead of using them, I would just use a target date fund to save on their fees and just have the fund rebalance over time to save you in those fees over time. But click on their site page, and then most companies are going to have a portfolio and management or it's not distribution. We'll see what it is in Schwab, but go to portfolio and management and scroll down a little bit. And it's going to tell you exactly what makes up that fund. So this 2055 fund, remember, this is for a younger investor, is 90% stocks and essentially 10% bonds. So this is a pretty aggressive portfolio. They're in all equity, so they're looking for long-term growth. And then if you go down, these are actually the exact funds that make up that one target date retirement fund. So if you invest in the Vanguard 2055 target date fund, you're theoretically investing in all 4 of these funds: the total stock market index fund, total international stock index fund, total bond market, and total international bond market. So that's where I say it's a fund of funds. Although you're investing in one fund, that one fund is made up of multiple funds. We'll look at Schwab's as an example. I think they have a lot more funds than just 4 in theirs. I think the last time I checked, they have like 10. So target date 2055. Scroll down. Portfolio. Okay, so they title theirs portfolio. But you'll see all of the funds that make up their 2055. They've got much more than 4. They even have RETs or REITs. These are real estate investment trusts. So they invest in essentially real estate. They even have small caps and then a couple little short-term bond funds as well. So that's how you would see what exactly makes up your target date fund. So anytime, if you see that's what you're invested in your 401k, definitely go research them a little bit more, see how much you're paying in fees, because some of these aren't that cheap that you're seeing in your 401ks. I think my plan, it was close to like 0.5% was the fees. And that's ridiculous when you compare it to Vanguard and Schwab, you're losing on fees. So definitely check those out, see how it's constructed, check the fees and see if that's a fund that you might want to be in or not be in. So now getting later or getting to the point now where you're managing your own portfolio. You've set up a list of funds that you're invested in. You've decided, hey, I'm not going to do the target date route, but I'm going to manage my investments now. This is something that I do personally as well. I manage my own funds. So we'll use an example right here. So you'll see 2 charts on the right. The starting amount is essentially an investor who invested $10,000 initially, and they had 4 type of funds that they equally distributed 25% to each investment. After 1 year, you will see that the allocations change a little bit because they had different returns throughout the year. So the growth and income category was up 40%. Growth was up 20%. The aggressive growth was didn't have any return. It was 0%. And their international fund actually fell 20%. So you see that the dollar amounts reflect the percent change here on the left. But the problem now is your allocation at the end of the year is now out of balance from what your desired allocation was at the beginning of the year. So you have to rectify this either on a semi-annual or annual basis. You have to get these kind of ranges back into your comfortable zones. And there's 2 ways to do this. The first way is you can sell your winners to buy more of your losers. So this is easiest to use in a retirement account like your 401ks, IRAs, TSPs, where you don't have to worry about owing taxes on profits because your money's growing tax-free in a retirement account. So in this event, you can just sell the winners. So in this case, you'll see these red squares is we actually sold 750 from our growth and income. We sold 250 from growth. And then we reallocated those sales and bought more of the losers so that all of our new values were now in that same 25% allocation that we desire. The math on how to find that balance is very simple. In the case of 25%, you just essentially take the portfolio value that you have at the end of the year. So we had $11,000 and then times it by 0.25, which is 25%. And then you get the value that each fund then has to equal $2,750. So do that math first on essentially how much you need in each fund that you're in before you do any type of the selling and buying, so you know how much to buy and sell. But that's kind of how you would do the math beforehand to see how much you would have to do. The other route, which is what a lot of people are in, because a lot of people in the Discord, we have our brokerage accounts, we're trading, we're investing in index funds for the long terms, but we owe taxes on an annual basis on these brokerage accounts. Not sure if you knew this, but you do owe taxes on gains, dividends, and things like that. But you have to be a little bit more careful with these because you don't want to do this. You don't necessarily want to sell your winners to buy more of your losers, because if you sell your winners, then you have to essentially report that profit to the IRS. So you have to pay taxes on those winners. So in this event, here's what I do. So instead of selling, I just contribute more money to my portfolio and then reallocate that new money to buy more of my winners or buy more of my losers and less of my winners. So in this event, I had to do the calculations. So the new account value is $14,000. So I inserted $3,000 more dollars.
We can't see nothing. What you doing, bro?
Can you mute your mics, please? So back to the math. So our final portfolio value is $14,000. So I had to times it once again by 0.25 to figure out that each fund needed $3,500 in each fund. So now that I knew that each fund needed $3,500, I went back to see what the values currently were in each fund. And that's how I essentially allocated my new money. So 500 went here, 1,000 went to aggressive growth, and 1,500 went to international. And that got all of my values back up to 25%. Two good news is here. I got back to my desired asset allocation, and I didn't have to report those capital gains taxes from sales. So this is, once again, if you're in a taxable brokerage account, you're generally just going to, instead of selling, you just want your new contributed money, buy more of those losers to get your portfolio back in your desired asset allocation. And it doesn't have to be all at once. You might not have $3,000 to just pop into your account, and that's fine. Do it consistently over time. If you only got $50, $100, 150, just can make sure you keep note of the amounts that you need to get to for that asset allocation and keep slowly building those accounts over time. Now towards the end of it, the safe withdrawal rates. So once we get to the point of an investor in that we have that multi-million-dollar account, we're ready to walk away from the workforce, finally ready to retire. We have to make sure that we withdraw a safe amount every year so that our portfolios don't run out of money. You don't want to retire at 60 years old with $1 million, and then 10 years later you spent all that $1 million living up life, and then you're 70 years old with no money left. So you have to remember, you have to pace yourself kind of with your withdrawal rates. So there was a study done, I believe it was 20 years, the Trinity study, which was essentially a group of 3 finance professors at Trinity University, did a mock study on how much different types of portfolios could withdraw every year on an annual basis, and how long that those portfolios essentially would not run out of money over a 30-year retirement. So I created a little heat map on the right. There was 5 types of portfolios. One that was 100% stocks, one that was 75%, 25% bonds, and then 50-50, and then 25% stocks, 75% bonds, and then 100% bonds. So you see in the dark green in their study that in these events, they all had a 100% success rate. So in their study, to guarantee a 30 that your money wouldn't run out of, you wouldn't run out of money. Or wait, I didn't even describe the 4% part. So it's essentially saying if you withdrew 4% of your portfolio every year. So if you had $1 million, you can take out 4% of that $1 million a year. So 4% of $1 million is 40 grand. So knowing that 4% part now, on the map back on the left, this is how much essentially that 4% worked under these scenarios. So a 50-50 stock to bond portfolio worked 100% of the time for every 30-year time period from their study. As it got kind of closer to 40 years, it tapered off a little bit. But if you actually check the right, I actually thought this was the most fascinating part of the study. Generally, people will say you want to get to more bonds as you get older to preserve your wealth. But the danger in that is if you get all bonds, your money's not necessarily keeping up with inflation. You don't have that growth element that you do with stocks. So that although you're taking out 4% a year, it's almost like you're taking out 6 to 7 to 8% when you or factor in inflation. So an actual portfolio of 100% bonds after 30 years had less than a 50% rate of success. And at 40 years, it was 11%. Almost all of the portfolios ran out of money. So it is definitely necessary to keep, at least from the past. And I'm not going to say these returns are guaranteed in the future, though past returns are never guaranteed in the future, but this was an accurate kind of study to use for a baseline for you. But keep a note that, like I said, you still need to have a good percentage of your holding in stocks, even when you retire, even if it's 50-50, but you still have to have that growth element. You can't it's not necessarily wise to keep it in all bonds. And the actual personal rule that I go by is I actually plan to only withdraw 3% of my portfolio every year in retirement. In my book, I have what 3% is every year. It's almost virtually 100% in a lot of these scenarios up till 40 years. But the same thing, if I had $1 million portfolio, I would only withdraw 3% of it every year, which is $30,000 every year, to essentially live off of that without ever running out of money the rest of my life. So this is kind of how a nice little study. You can also Google it as well. It's called the Trinity Study. It's just a good little thing to play around with in terms of long-term planning, how much money you're going to need and things like that. How you get to that total money mark of when you can walk away. I didn't include the math here, I believe. Yeah, but you would essentially take your annual expenses. So if your family spends $30,000 a year, you need 25 times that in a portfolio to live off of that 4% rule. I'll do the math real quick. 30,000 times 25. You would need a $750,000 portfolio to then withdraw 4% a year to live off of. But if you're maybe a little bit more expensive, your family spends $75,000 a year, times that by 25, you need a portfolio size of 1.8 million, a little bit more than that, to live off that 4% a year, so that you can keep living off of $75,000 a year. So that's the math behind that a little bit more. Hopefully this gives you a little bit better planning for your long-term withdrawal rates. And that concludes the index fund investing presentation. I hope you all got a little bit of nuggets here and there in terms of kind of my investing strategy that I use. It's a great long-term strategy. Like I said, hopefully it connected some dots. Appreciate you guys coming on now. And I'll stay here for another 30 minutes to an hour to answer your guys' question. I haven't checked in the chat yet, but feel free to fire off your questions and I'll take them one at a time.
I have a question.
Mhm.
So I have a employee sponsored Roth 401k account, and I actually bought your book last year, and I chose to go the route of the Target retirement fund. And during this presentation, you read me a different ticker symbol than the Vanguard Target fund that I have, and mine is still 2055, but I see that my expense ratio is way more than the one that you showed. Am I in the wrong Target fund date?
This is in your Roth 401k at your employer?
Yes.
So you're most likely in what's called an institutional fund. So
Yeah, that's what it says. Mhm.
Yep. So these are, when you're with a 401k, usually it should be less. I'm surprised it's a higher expense ratio. Generally, when you're in an institutional fund, the fees are smaller because your whole company's investing. Do you know the ticker symbol to it?
Yeah, it's VIVLX.
Can you still see my screen?
Yeah, it's 0.09 expense ratio.
You're paying less than the example I actually used. The one
okay, that's less.
was 0.15. So you see 0.09, Vanguard 2055. Yep, 0.15. So you're actually saving 0.06. You're paying a little bit less in your institutional fund.
Okay, I just want to make sure I'm still on the right track. I'm in the right fund.
Yep. And are you in the same year that you plan to retire as well?
Yes.
Okay. Yep. Then you're all good. Also, another little trick that I tell people as well, depending how aggressive or conservative you are, if you've got a little bit more, like if you need to grow your money a lot more and you need to play catch up a little bit, invest in a target date fund that's like 10 years past when you plan to retire. Because what that's going to do is invest you in a fund that's going to be more stocks as you grow older than just your date fund. So it's going to keep you a little bit more aggressive. Also, you could do it in reverse. If you've got enough money and you want to calm it down, you could do one that's closer than your retirement date. But that's just kind of a small way that you can play around with those as well.
Okay, thank you.
That answers your questions.
It did. Thanks.
Yeah.
I have a question.
Yeah.
Okay, well, first question is this gonna be posted somewhere?
Yeah, so a lot of people have been asking me, when is that UTMA 529 demo I did last week going to be posted?
Yeah,
I don't have admin rights to that posting part of the Discord. I'm coordinating with the guy who does have the rights, and he said all of the past videos are going to be posted by this weekend. There's a pretty big backlog on those. So I'm going to keep getting on him. He wants me to get on his case to make sure that it's posted. So hopefully by this weekend. But if you don't see it posted, DM me, and then I'll keep DMing him to make sure that these get posted ASAP.
okay, and I have a question because I have a 401k. I chose Roth,
Mhm.
for my employer,
Mhm.
um, and I noticed. Well, first of all, I have the 2060 fund. So
Mhm.
you're saying that if I want the money to accumulate faster, or if I want to be more aggressive, I choose a later date or a later year. Is
So
that what you mean?
what I was saying is, I'll use my dad as an example.
Okay.
This might make it easier. So my dad is a little over 60, and
Mhm.
he doesn't have a lot in his 401k. So what I did for him, because he was invested in a target date, essentially retirement fund that was for like this year. I think it was like the 2020 or 2025 fund,
Mhm.
meant it was primarily bonds. So that meant a lot of his growth was capped, because now most of his portfolio is in a safe conservative fund. So what I did for him was I invested him in a fund that was like 10 or 15 years away from now, because he still plans to keep working. But what it does is it gives him more exposure to that stock, more stocks, less bonds. So it really just depends on how much you have invested right now and how close you are to your goals of being able to retire at
I
that.
mean, uh, I still have like another like 40 years, so
Yeah,
I don't really, I'm not like in a rush or anything, but
yeah,
I was just asking because
yeah,
I don't want to retire that late. Kind of want to retire earlier, but
yeah.
yeah. But I noticed that they're not taking the money from my taxed paycheck. They're
Mhm,
taking the money from my gross income. Shouldn't
mhm.
it be there that they're taking the money from my taxed paycheck if it's a Roth?
No, so Roth, you're paying after tax.
Yeah, but I noticed that they're taking it, like, when I did the calculations, the
Mhm,
amount that they're taking and putting into my 401k Roth
mhm.
is the percentage from the gross income, not from what is
Oh,
all.
pre-tax essentially.
Yeah. So that's
So
why I'm like, why are they
yeah.
doing that if I chose Roth?
So I would contact your HR just to make sure that you are in the Roth. I would need to see like your pay stub and things like that to actually see what's going on.
Okay. And when you buy, like, if you open up a different brokerage like TD Ameritrade or something, and you just buy index funds on your own, how do they take the expense ratio? They just take it out of
Yeah,
your.
you're not going to have to worry about that. They'll essentially, you'll look, it's usually on an annual, it is an annual basis. So you'll see, check in like December or January, and like in your, whatever you're using, go into like your history or your transaction history, and you'll see like that little fee or expense ratio automatically done. You're not going to have to worry about that.
Okay, got it. Thank you.
Yeah.
Good evening, sir. How you doing?
Good. How you doing?
I'm not too bad, thanks.
Mhm.
I'm 30 years old. I
Mhm.
have about $7,000 in cash. I'm in Canada, but our retirement funds are kind of similar to United States.
Yeah.
I was thinking of putting most of it in the stocks like VGT, VTI, and BO.
Mhm.
I was wondering like your opinion on that.
So I don't think you don't have access, I believe, to VTI and VGT as a Canadian investor. Your funds are a little different, although I know Vanguard offers their services to Canadian citizens. They have a portal for Canadian funds, or like their equivalents, essentially. I think last time I thought it was VUV was essentially the equivalent to VTI. I'd have to check again. But this,
Actually, we can buy VGT.
you
in
can do
Canada.
VGT.
Yeah, and VTI.
Oh, that's pretty cool. I didn't know that. Um, it's hard for me to say exactly what, if that's good for you, because what's good for you might not necessarily be what's good for me, because although that we're the same age, might have different money, we have different goals. I personally love VTI and VGT. Those are big funds in my own portfolio, and I just add to them on a consistent basis. The main advice I would give you is, if you're going to invest in a sector fund like VGT, I cap all of my more aggressive growth investments like VGT to no more than 10% of my portfolio.
Okay.
So although I like the IT sector, I'm not going to let it run rampant in my portfolio. I'm going to keep it at that 10%. And then I'm going to put most of my money in those broad market index funds, ETFs like VTI, VU, things like that. It really just depends on how much money you want to get, what's your risk tolerance and things like that in terms of like your percentages and how you break them down. But those are definitely good funds if you can invest in them.
Okay, appreciate it. Thanks.
Yeah. I'm going to answer this one real quick. He's asked, why did the guy have an investment advisor when he was just investing in an actively managed fund such as ARK? So that was just used as an example, because a lot of people who are uncomfortable managing their own money will go to their banks, whatever their closest financial institutions are, and they'll ask for their investment managers to manage their portfolios. So even though that they could essentially invest in ARK by themselves, they're uncomfortable doing it. So they just give their control to these investment managers who tack on their own fees and invest in whatever fund. So that was just used an example, but that's kind of what happens with investment advisor fees. Hopefully that answers it. And feel free to ask questions too. I'm just going to go through this chat.
I have a question. Great information. Is very informative in terms of understanding how to look into these funds. But I was just curious as to what you look for when you're looking for a fund. I know you talked about the different sectors and so forth and so on, but there seems to be like an array of funds that we can look for. And I know we have to do our own research and find out what's best for us, but what do you look for? How do you go about doing that research?
Okay. Two main things I look for. One is the expense ratio that I showed you guys. But here's a great way to also compare how these funds are doing against the index it's tracking. So although I've seen some funds say that they're an S&P 500 index fund, but then I'll go check their performance against the S&P 500 and they're actually lagging it. So they're not even a well-constructed fund. So the first two things I look for, or the first thing I look for is expense ratio. And then the next thing I look for is that it's actually tracking the performance and getting that same return of the index. So if you actually Google your fund, I'm using the Vanguard 500 Index Admiral. So Google the ticker symbol and then Morningstar. It's a great kind of comparison site. And you can go to this performance tab. And then it's going to give you, when this populates, essentially a 10-year chart that will show you the index fund's performance against the S&P 500 itself. So where do we got? So you'll see right here, this is our index that we're tracking. The S&P 500 is the index, right? The value, so this chart is essentially if someone invested $10,000 10 years ago, how much would that have grown over time? So $10,000 invested in the S&P 500 would have grown to $39,000 or $39,009 over that 10 years. Our index grew to just about the same performance. It was 38,207. The most likely only difference was because you have to account for the fees for the fund, but it was tracking the index. So if I came in here and I saw that VFIAX was like 34,000, well, that's a $5,000 difference from the index. Now I see that it's not necessarily tracking the index well. So that means I'm not in a good S&P 500 fund. It's not doing what it's designed to do. So those are honestly, the two main things is fees and how well it's done against the index that I'm trying to track. Does that make sense?
Yeah, I guess I was looking for which funds exist. Like, is there like a place where you can go to see also, because no, this is excellent. I didn't know this part, but is there another place where you can go to say, okay, I want to see which funds, and then I can compare them to the S&P and then choose which ones I want to get into?
So essentially you're asking for a site that where you can compare multiple funds against the S&P 500. Is that what you're saying?
Yes.
Um,
Like, how would one know about a fund? You know, like, how would one even know about it?
That's actually a good question. So what I used to do when I was like just starting off is I would literally just Google like best S&P 500 index funds. And this, I would just literally start from scratch. I would go to whatever ones, Investopedia is a good one, but they'll give you probably, if you scroll down, where is it? A list of essentially S&P 500 index funds with the ticker symbol. So they've got Fidelity's with all of their main information. Schwab's is in here, Vanguard's is in here. So I would honestly just do a Google search of what exactly you're looking for, in all honesty. If you're looking for like technology sector funds, so I was using VGT as an example. Just Google technology sector funds and just you can at least start accumulating a list of ticker symbols that you can then impute back into Morningstar to see their performance against the S&P 500. But that's kind of, I don't necessarily have a site off the top of my head that just lists off like hundreds to thousands of funds.
No, that was perfect. Exactly what I was looking for. So thank you.
Okay. Yeah. Cool. Where's the chat? Okay.
I had a question about 457 account.
Okay.
So for the most part, you can't control the options, right? They give us an option where I'm at for 3 different companies.
I have to remind myself what exactly 457. What kind of, you work for a state government?
Correct, work for the county.
Gotcha. Okay. What's your question?
And they give us the option of Nationwide, AIG, and Voya. But we can't do anything. We just have to use the accounts that they give us, right? We have to choose from the funds that are there. There's nothing we can do. Like if none of them go with Vanguard, we're kind of stuck, right?
Yeah. So that's the crappy thing about like 401ks and 457s. Unfortunately, you have to pick from the fund options that they offer. So I just changed companies, and my old company had a bunch of Vanguard funds, but now I'm in a company that has higher expense index funds that are 5 times the cost. And unfortunately, that's what I have to pick from. I can't like ask them or search up Vanguard funds to invest in. So you kind of have to play their game. What I would advise you to do in that case is prioritize maxing out your Roth IRA first, because you're going to pick the funds. That's $6,000 a year, and then go back to your 401k or your 457 if you want to invest more into retirement. My personal investment is I only invest up to the employer match now, but we have a bunch in retirement, so we don't need as much there. So I do the employer match, then max my Roth IRA, and then the rest goes to my brokerage, just so I can control the funds.
So you're not a fan of maybe potentially maxing out the 457 other than for tax advantage?
Depending where you are, like in your journey. So I'm 28, and me and my wife have like a little over $200,000 in retirement accounts. Well, over 30, 40 years, even investing only to the employer match, it's still going to grow to a couple $1 million. But if you're like a 35, 40-year-old worker who only has like $5,000 in retirement, you might want to consider maxing out that retirement account, especially if you have good fund options. So you can get those tax benefits as well as growing your retirement account. So it really just kind of depends on what your situation is. It's not a kind of cookie cutter answer, unfortunately.
Appreciate you.
Yeah.
Hi, I have a question. So I have a 401k plan with my employer. I do the employee match, but every year it goes up 1%. So would you just stick with the employee match and then invest the difference into your Roth IRA, or just continue with the yearly increase?
Do you have a Roth IRA?
Yes, I do.
Do you max it out every year?
No, I was going to start doing that now.
So that's kind of what I said in the last one. So what I would do is, just because you can, I don't know what the funds are in your 401k. But
Mhm.
with a Roth IRA, you control the funds. You pick whatever you want to invest in. So I would still invest to get that company match, get that free money, but then go back, open your Roth IRA and focus on putting that $6,000 in a year before adding any more into your 401k past the match.
Okay, thank you.
Can I invest in these retirement funds if I don't live in the US? No. The guy who just called from Canada said he could invest in VTI and VGT. I actually didn't know that, but for the most part, you can invest in the exact same funds. You might be able to invest in an equivalent, but most likely you're not going to be able to invest in the exact same fund that I was talking about. Would it be possible to see the TDF page briefly again? Not sure what exactly. If you want to speak up, I don't know which page, if the PowerPoint or the demo. Sounds more reactive compared to a more active. Do you recommend value averaging? I'm not quite sure also what you mean by value averaging. Once again, if you hear me talking, it's your question, feel free to ask it as well. Recording, yes, it'll eventually be posted. Yeah, I'll put the title of my book in here right now. So a lot of those charts that I actually put in the PowerPoint are directly from my book. I used probably about 30–40% of those charts from my books. I thought they were pretty good illustrations. But this is the ebook that I have. I've actually got, I think, doing a sale today for another milestone. I think there's 12 copies left at 20% off. So if you are interested in that, feel free to DM me. I can shoot you the link to that as well. It's 100 pages, a little bit more. It's pretty much a more in detail of the PowerPoint that I just gave. Let's see. Oh, people posted links. Okay.
I have a question.
Yep. What's up?
Being that in the later years, like 45, I'm 45. Did you state that the TDF was more aggressive and better? Was I mistaken or no?
So what I was saying is, if you are essentially, if you're later in your working life, you said 45, and if you think you're behind in your retirement, so the target date fund that you would be in if you're 45 is most likely the 2035 or 2040 fund. That'll be when you're about 60 or 65 years old. What I would do is, if you're behind, kind of like you need to get a little bit more growth in your investments, instead of investing in that 2035 or 40 fund, I'd invest in a 2050 fund that's 10 years past when you plan to retire, because that means you're going to be a little bit more heavy into stocks than you are the bonds. So it's going to be a little bit more aggressive growth in how it's structured. Does that make sense? If not, feel free. I can try to explain it again. I know it's not the easiest concept. It's just something different I do.
I'm sorry, I have a question.
Yeah, what's up?
Hey, so I'm looking at these funds, trying to see if I can find one that that maybe suits me though. But I'm looking at the return rank in category 3-year or 5-year or 10-year.
Yep.
Is the higher the percentage, is that a better or is that worse?
So all that's doing essentially, let's look into it. Let's use an example so everyone can see. I'm not looking at the same fund you are, but we'll go into the performance. Okay. So all funds will give you that kind of 1-year, 3-year, 5-year, 10-year average return. So what it's doing is essentially the 1-year return for the S&P 500 fund was 17%. The annualized return over 3 years was 11.67%. So what that did was it added the returns for the past 3 years. So for 2020, 2019, and 2018, added them up and divided it by 3 to get the average. Same thing for same for 10-year. So it's giving you the average return over that time period. So future returns, like for people who are invested for the past 10 years, it's been great return. But future returns are never guaranteed based off of past results. So it doesn't mean just because it was 13% for the 10-year period, the next 10 years is going to be 13%. It's just showing you what it was over the past year.
Okay, appreciate the answer.
I would check, though, a lot of the funds will have the since inception. That's going to be your more, that's what you want to look for more. So this fund was started in 2000. So what was that, 21 years ago? You want to, if you want to judge kind of really how the fund has done over the long term, go back as long as you can. That's generally this field to see how it's really kind of done. 7.19. The S&P 500, I think, averaged about like 9.5 to 10% over the past 100 years. But there's been 2 crashes in between 2000 and 2021. So that's kind of maybe that little difference. Does that make sense?
Totally. I appreciate that, man.
Yeah.
Hi, I have a question. I think you covered this, but I'm a little confused. So 401k Roth versus Roth IRA. I know that you can max out your Roth IRA, like you can just put in 6,000 anytime all at once. Yep. But do people max out their 401k? Like, can you just take the money and put it in there, or do you have to like have it taken out of your paycheck?
No, it has to get taken out of your paycheck.
Okay.
So this is always going to be from your payroll. Some people, although if you are going to max out your Roth 401k, just take, so.
When you say max, the maximum amount of the year over time, or like, cause I know, I think it's like 19,000.
Yeah, you're allowed to put in 19,500.
All at once?
Yeah.
Oh, okay.
But like some people, so some really high income earners will try to max it out very early on. So
Yeah.
go crazy and try to like max their 401k in like the first 6 months of the year. But the little problem with that is you're going to lose out on your employer match after that, because just because you contributed all of the money doesn't mean the employer contribution match is going to catch up. So it's generally kind of smarter to dollar cost average those over the full year, so you keep getting that employer match, if that makes sense.
Yeah, okay, that makes sense. And then can you just real quick explain compound interest again?
Sure. Let's go back to I'm not gonna lie, it took me like 3 years to fully grasp compound interest, because our brains aren't wired to understand. I think it's called like exponential math, which is like money just multiplying off of each other. Our brains are better adding and subtracting numbers, so it kind of goes crazy. So compound interest, the way you earn it is different between a stock and a stock index fund and like a bond. So the difference between a bond is it's a loan that's someone will give, and then they'll get a fixed rate back. So if let's say your friend needs $100 and you loan it to them, but you say, hey, I'm going to give you $100, but you're going to return me 5% back. So they're going to bring you back $105. That's how you would earn interest on a bond. On a stock or a stock index fund, you earn money based off of appreciation, which is essentially all the underlying stocks of your fund are making money. They're increasing in value. Kind of like what you heard with Tesla this year, the Tesla stock shot up. That's appreciation of the stock. And then also dividends. So in this event, the starting kind of balance, that $1,000, do you see it at the top?
Yeah.
It's just assuming your investment is growing 10% a year, right? So in the first year, that $1,000 is going to earn $100 because that's 10%. So when you start the next year, you're now at 1,100. you have your original principal and you had interest that was accrued on top of that. So now when you earn 10%, you're not only earning 10% on that initial 1,000, you're earning 10% on that 100 that you earned in interest the past year. So 10% of 1,100 is $110. Then that gets added to the principal the next year. And then essentially your principal, once again, is getting that 10%, and that interest that keeps growing is hitting that 10%. Does that kind of make sense?
Yeah, that makes sense. So that interest is coming from just the you buying the index fund and it growing, like it accumulating money. But the next year, so when you're at 1,100, even though that $100 technically is not your own money, it's still gonna accumulate on top of it.
Yep.
Like, okay.
Yep. And then that's when when you like start projecting out like decades, that the money almost gets crazy, because think about, so 10% of 1,000 is only $100, right? 10% of $1 million portfolio is $100,000. So as your money grows to like crazy high numbers, that compounding interest is going to get bigger and bigger and bigger. I won't keep going deep into the math, but I think you're starting to get the premise in that essentially your interest that you're earning is continuing to earn interest as well.
Yeah, makes sense. Thank you.
So. And I'd keep Googling examples of it as well. I still Google examples to this day of compound interest to try to understand a little better. I understand compound interest, but it's a different type of mathematical equation than what we're used to understanding as humans.
Hi, I have a question.
Yep.
Can you hear me? Okay.
Yeah.
How are you?
Good. How are you?
I'm good, thank you. I'm 39 years old. I have always been, I've been in my employer 401k for the past 3 years. But last year I decided to invest by myself. So I took all the money that I had in my savings account and I opened a Roth IRA and I maxed it out.
Nice.
And I also opened a brokerage account and I dumped $8K on the VT Sachs. So I'm basically investing in my Roth. I'm investing in the FAIX, I think it is. I don't remember exactly, but it's also the one that mimics the S&P 500. And I'm also doing the same thing in my brokerage account, investing in the VT Sachs. I'm just trying to be a little bit more aggressive since I am already 39 years old.
Yep.
So I'm wondering if I am in the right, direction.
So I personally, those are two of my favorite Vanguard funds, VTSAX and VFIAX. I'm just in my Roth IRA and brokerage, VTSAX makes up the majority of my portfolio. I also have an international fund in both. And I pretty much just took that off of Vanguard's own recommendation. So hold on. International, let's see. International, let's do this. Investing internationally. So I read their Vanguard's annual reports a bunch, or on an annual basis, to kind of get where they're projecting returns to be in the future. And their latest forecastings actually recommend, or they actually are predicting that the international stock market is going to outpace the US stock market over this next decade. Their recommendation is that you consider investing 40% of your stock portfolio in international stocks. So if you have $10,000 in a Roth IRA, you would put 40% in what's called VTIAX, which is the total international stock index, and then the remaining 60% in VTSAX. And that would give you essentially a globally diversified portfolio. How I do it is 70-30. So we just use two funds, VTSAX and VTIAX, and go that route. But in terms of getting a little bit more potential aggressive growth, you could check out that international route. Feel free to research kind of Vanguard's 2020 annual report, their future forecastings, and you can get a little bit deeper dive in there as well.
Okay, great. I appreciate it. Thank you.
I got a question.
Yep.
If my employer doesn't match contributions, is it still worth investing in a 401k?
It could be. I need to know kind of how old and how much money you have and what your goals are. But if my first step would be is like I tell everyone else, max the Roth IRA before you put anything into that 401k. Because I don't know what the funds are either. You might have expensive funds, you might have good funds, but in your Roth IRA, you at least control the funds you're in. So put that 6,000 in, and then if your employer has good funds, sure. Like if you want to stuff your retirement accounts more, go for it. Or you can put it towards your brokerage.
Well, that's what I was saying. That's actually what I wanted to say. It's like versus doing it, just a brokerage itself.
Yeah. Well, how old are you?
38.
38?
Yeah, I've been paying into it for like 10 years. I got like 100K in there, but
yeah. So here's what you can do. I would use a compound interest calculator. So you can just Google it. The one I used, or compound interest calculator. So this is what I first did when I started to pull back investing in my 401k, because I actually used to max out my 401k a couple of years ago, and now I only do the employer match. So Google actually investment calculator. And you said you were 38, I think.
Yes.
Put in just kind of projected numbers of when you want to retire, when you plan to. I'll just use 60. I'll just use 100,000 as a hypothetical. And then however much you're contributing, put that in there. If let's say you're doing 400 a month, and then pick your annual return. I use 8% as a conservative kind of long-term growth rate, and then just hit calculate, and that'll show you where you'll be at time of retirement. This kind of goes into my last PowerPoint slide, that 4% rule. It depends on how much you're going to need at the end. If 864,000 is enough for you to live off of the rest of your life, then you might be able to be okay in pulling back. But if you need more, you might have to contribute more. So it's kind of up to you really with your goals. If you want to, we can talk, you can DM me and we can talk a little bit more about your specifics, and maybe I can tell you what route I would probably go down.
Definitely.
Yeah.
Thank you.
Yeah, I wish I could always kind of give cookie cutter answers, but everyone's situation is different. So my advice can't ever be the same for everybody because everyone's goals and risk tolerance is different.
I have a question. I think I'm getting like the index funds and ETFs like mixed up or whatever.
Yep.
So on my account, I do invest in the ETF for basically VOO, VOO.
Yep.
So these tickers that you've been talking about for the index funds, is that something I can go into my brokerage account and like buy or whatever, or is it something that I have to?
Where's your brokerage account with?
E-Trade.
I don't know if so. Some of these brokerages don't allow you to buy the index fund versions; they just allow the ETFs. E-Trade might let you do it. I wouldn't worry about if you're already in VOO. Don't worry about going to VFIAX. They're doing the exact same thing. There's no structural difference. Literally the only difference is, once again, I don't want to try to like simplify it too much, but it's just how they're traded. So when you place those VOO orders, right?
Right.
You'll notice that generally, if you're just doing a regular market order, they're pretty much buying right away at whatever that market price is whenever you bought it during the day.
Right.
If you went back, you would have saw it triggered pretty much exactly when you bought it. If you bought VFIAX, you're not going to see that it actually bought until the next day. So literally just think the difference is an ETF, treat it like a stock. It's just traded throughout the day, just like any other ordinary stock. A fund, it just trades at the end of the day. But structurally, an ETF that tracks the S&P 500 and an index fund that tracks the S&P 500 are going to do the exact same thing.
Even with the compound interest?
Yep.
Okay.
Because they're both growth. So as the S&P 500 grows, the ETF that tracks it is growing just the same, and the index fund that's tracking it's growing just the same. You're still going to earn essentially the same dividends. So you're in terms of the growth, there's going to be no difference between both of them.
Okay, got you. Thank you.
It's a good question though. ETFs and index funds, they're very simple in like what they are, but they're kind of complicated to understand like the difference between them. It took me kind of a while to really like understand the difference in them. So if you got more questions, feel free to DM me or keep Googling. I'll keep trying to help you out if you got them.
All right, appreciate it.
Yeah. 10 years until I have some catching up to do on my retirement fund.
Hello.
Yep.
I have a question. What do you recommend for people who are running their own business and want to retire or coming up to retirement?
Do you have a SEP
IRAs?
Do you have a SEP IRA?
No, actually, I don't have nothing as of yet. I'm looking into. I just started with stocks and things like that.
Also, do you have a CPA yet?
No.
Okay. My first recommendation with you is get a CPA. You can feel free to DM me. I can actually refer you to my guy. I just started with him this year for my small business. But they're going to be great in terms of they're going to save you thousands in kind of tracking or being able to get you through those expenses, loopholes, and things like that. So get with a CPA, but a SEP IRA is a great retirement as a business. Are you the business owner?
Yes, I am.
Okay, so SEP IRAs essentially allow you to put away up to, I think it's 25% of your business's revenue into account, or 57,500, whichever comes essentially, whichever is the lowest. So if 25% of your revenue is more than that 57,000, you're going to be 57,000. But the good news for you is not only are you investing that money into your SEP IRA, but it counts as an expense to you as well. So it deducts from your revenue as well, because you're essentially paying out into the retirement plan as the business owner. So a SEP IRA is definitely a good one. I was able to shield, I think, an extra $6,000 in a SEP this past year that I got to write off and put into a retirement for growth. So definitely recommend the SEP IRA and getting with a CPA to help you out with that.
Okay.
Yeah.
Thank you very much.
Take care.
27
minutes. Question. So can you hear me? Sorry.
Yeah. Can you talk a little louder though?
Yeah, sorry. So since I have a 401k Roth, I was not going to open up a Roth IRA because I was just going to open up a brokerage and just buy index funds. But do you recommend having a 401k Roth and a Roth IRA?
Well, I always recommend having a Roth IRA. A Roth IRA is my favorite investment or retirement investment account because your money's growing tax-free and your withdrawals are going to be tax-free, and you control the investments. So it's kind of the ultimate retirement plan in my eyes. So I always tell people to get a Roth IRA because, like I said, when you control the investments and it's growing tax-free and the withdrawals are tax-free, it's a win-win-win-win. So I definitely wouldn't ignore the Roth IRA. What I would do is maybe consider investing less into your Roth 401k and focus more on your Roth IRA as opposed to not opening a Roth IRA. Does that help?
Yeah, thank you.
Me, myself, I have a Roth IRA and a Roth 401k.
Okay. Well, I'm not gonna, the thing with my Roth 401k is my employer matches, so I don't want to reduce contributing. So I think I'd rather just keep it at that just so I can get the match. But I'll definitely look into opening up a Roth IRA.
Okay. And like I said, feel free to DM me too if you want to give me like more details and we can talk through it as well.
Okay, thank you.
I'll answer this, the military question. I have some catching up to do on my retirement fund. Fortunately, I think if you've got 10 years left, you must have came right out of high school. So you're probably under the old pension setup. So you at least have the pension as well. So I'm catching up in the retirement fund. Will picking a later date retirement fund apply? All right, let me look if TSPs have retirement date. TSP target. Okay, so you do, military does have, or the TSP does have life cycle funds. So let's see. Yeah, so same concept. If you want to catch up more in your TSP, I think you said you're 10 years out. So you're probably in the 2030 fund, I'm going to assume. If you want to be a little bit more aggressive, I might do the 2040 fund. So if you come into your 2030, you'll see, let's see. Oh yeah, all of them have different naming conventions. But essentially, the difference between the 2030 and the 2040 is it's going to be more geared to the S&P 500, the stocks. So I would maybe go for the 2040 or 2045 fund just to be a little bit more aggressive in your scenario. But the good news is, like I said, you kind of have the pension as well. Would you explain what kind of went over that? 39. Also don't. I think we talked about that. That sounds.
Hello.
Yep.
Hi. So I have a question. My employer used to have us enrolled into a SEP IRA. Then he moved us over to, well, what we have now is a simple IRA. Should I still, is it worth still, I mean, all my contribution now goes to the simple IRA and he matches. So should I still keep this SEP IRA or withdraw the money and try to put it on into the simple one?
Wait, you have a simple IRA with a company?
Yes.
And then what you have, you said there's another one?
He used to have us first enrolled in the SEP IRA.
Okay.
But we don't have that well, I still have my money in there. But that's all of my contributions and stuff go from my paycheck go into the simple IRA, which I have that Vanguard 500 open.
Oh, your simple IRAs with Vanguard?
Yeah.
Oh, that's good.
But I still like then what happens with the SEP IRA? Is it just, I mean, I still see the money's going up on it, but
that's a good question. I've actually not heard of that situation before. But if you, is this a very small business?
Yeah, super small. It's only like
a couple people.
Yeah, like 45 of us really.
Yeah, okay. That'd be interesting why you're in a SEP IRA, because I thought SEP IRA.
Like with the SEP IRA, I was able to choose whatever I guess like funds I wanted to. So I have the small cap, the Target 2050, and some real estate ones. So I was contributing into all of those when we first started, but now it's just all going into that Vanguard 500 in the simple IRA.
Yeah. I don't have the answer for you right now, what exactly I would do with it. If I'll do a little bit more research, so please DM me the Wealth Dad on the Discord, and I'll get you the final answer. What I would do, if you can, is roll over that SEP IRA into a Roth IRA, because technically that's an old plan. But I need to do a little bit more research. Also talk to my CPA on what he recommends his clients do kind of in that situation, because you're in a unique, smaller business setting. So shoot me a DM. Sorry, I don't have the easy answer for you right now, but I'll get it to you.
Okay, no problem. How do I, this is like the first time that I'm using this thing, so how do I like DM you or where?
Sure. So let me go into the you have the Discord app?
Yes.
Okay. So if you open it and you essentially, where is it? If you scroll, I believe, to the left or to the right, you'll see the Discord and then like direct messages pane. And you can search names. Just search the Wealth Debt. Here, I'll put it in the chat. Search up that, and then you'll get my profile, and then you can just shoot the DM question there.
Okay, got it. I found you. Okay, cool. All right, I'll do that. Thank you.
Yep. And please message me because that's a good question. I like when I hear kind of those that I haven't run into before.
Yes, I definitely will because I'm confused myself. I don't know.
Yeah.
All right, thanks.
Yep. Book. We put I think people have put in the link in the bot or in this chat if you want to check it out there.
Hi, I have a question.
Yep.
I back in about June, I quit a company which I had been with for a long time, and I have a 401k with them, and it's just kind of been stagnant there, just sitting there.
Yep.
And I'm interested in gaining a little more control on how to grow it, and
sure.
And also, having access to it to maybe invest. But I don't know if there's a way to do that without too many penalties or losing some of the money.
Yep, that's a great question. What happens to employees when they leave an old company? What do they do with that old 401k? Here's exactly what I would do. I would open up an IRA with either Vanguard, Schwab, or Fidelity. Vanguard, that's my kind of number one place to go. But open an IRA with them and then initiate a rollover. So what you're going to do is you can just call Vanguard's customer support, but they'll essentially walk you through and pretty much help you set it up to where they'll reach out to the old 401k company and roll over that money into the IRA. And you're not going to pay any penalties or taxes or fees because it's just a rollover into this new retirement account. And then once the money is sitting in your new essentially rollover IRA, you are then free to invest in the funds that you see fit at that point. So that's what I've done with my old 401ks is I just roll it over into my IRAs at Vanguard and then reinvest that money into the funds that I want them in.
And the gains that I get or losses, how do I have to report those since I'm actively, investing, or how does that work?
Nope. Your money in a retirement account grows tax-free. So you're not gonna have to report any of it. Depending on if you had a traditional 401k or a Roth 401k. If you had a traditional 401k, you're only gonna pay taxes when you start withdrawing the money at retirement. So after 59 and a half is the kind of age where people start pulling from. So you'll pay taxes then, but not on any of this transferring or reinvesting.
Now, I just started hearing about the SEP IRA, which I had honestly never heard of, and I do have a small business. I have a eBay store that I manage. How do I kind of integrate that into what I have going on?
Yep. So same. So the good thing with a SEP IRA is you don't need like an LLC or EIN number to open it, which is kind of nice. So literally in terms of opening it, you can literally just Google open Vanguard SEP IRA. And it's most likely going to be the first thing that comes up. Let's see, details. You would have to create an account if you don't have them, but you can essentially log in and open the SEP IRA directly through them. But once again, if you've got a small business and you're doing this type of setup, we've got expenses, I would definitely work with a CPA. If you want, like I said, DM me and I can give you the contact to my guy. He's fantastic in this. But the first two options the first two recommendations are get with the CPA, let them know your expenses, because there's a certain amount you can put in after you deduct essentially all your regular business expenses. So you have to keep in mind in that you don't contribute more. But the actual setup's very easy. It's almost just opening up your own IRA where you just put in like your name, social security, income, all of that.
Got it. Okay. Okay. Thank you very much. I appreciate it.
Yeah. Pension. Yes. If you're a teacher with a pension, I would also open and max out a Roth IRA. I think you're getting confused though. So you're saying maxing out a Roth IRA prior to placing money in index funds. So a Roth IRA itself is not an investment. It's simply an investment account. Index funds are the investments that you would hold within that retirement account. So you can buy index funds within a Roth IRA or a regular brokerage account. But just keep in mind that little difference. I've got a sister as well who's a teacher who I have been managing her Roth IRA for years. But yeah, if you can afford it, if, like I said, you're making enough money, I would definitely try to max that Roth IRA as well, in addition to your pension. Oh man, I don't think I'm gonna be able to get all of these.
Sorry, another question.
Mhm.
So just to make sure I'm understanding this right, so I have an old 401k from a previous employer.
Yep.
I didn't do anything with because I've just been putting it off.
Mhm.
So, can I take that old 401k and just make it into a Roth IRA for myself? You know what I mean? Like,
Well, it depends if it was a traditional 401k or a Roth 401k.
it was a Roth 401k.
It was a Roth, so then you can very easily roll it over into a Roth IRA at your whatever place you have the IRA at.
Okay.
Once again, it's the same concept though. If you can't figure it out online how to do the rollover, just call the customer support and easily direct you through it. And most likely do it for you.
Okay. Do you recommend doing that, or do you
Yep.
recommend?
Oh yeah, absolutely. Because you're most likely paying some type of management fee for the old company to still be managing your money. You want to save on all of those fees.
Okay.
Yeah.
Thank you.
Crap.
Yeah, I have a question.
Yep.
I know you were recommending Vanguard, but if you start your IRA Roth at like another brokerage, is there a lot of fees involved to switch over to Vanguard?
Who's your brokerage now?
Oh, I haven't started it yet. I was just wondering this.
I mean, no. So I always tell people my top three are Vanguard, Schwab, or Fidelity. They're all low cost financial firms. Most of their investment options in terms of their index funds are pretty much the same. So if you started with like Schwab, I'm not going to tell you to go transfer everything to Vanguard because you can find similar stuff there. I just tell people if they haven't started to use Vanguard because Vanguard is the company who first introduced index funds to the open market for average people, like average Joes like us, to invest in. They did, I believe, in the 70s. So they've have the longest track record of low cost investing, which is why I tell people just go with the people who started it. But just be fine if you use Schwab or any of them.
I have one more question.
Mm-hmm.
Hello. You just told me about the Roth IRA and the SEP. Now, if I open up a IRA from my old 401k with Vanguard, do I keep a separate account for my business as a SEP, or do those integrate, or how does that work?
So you can still fund your Roth IRA and a SEP IRA. So me this year personally, I've already maxed out my Roth IRA and I funded my SEP IRA.
So I can have both accounts with them.
Yep.
Okay.
Yep.
Perfect. Thank you.
Mm-hmm.
Hello, I have a question.
Mm-hmm.
I'm just making sure you can hear me.
Yep.
The Roth IRA, you could open it like with money that you have saved. It has anything to do with what you earn or what you report. It could be like if it's my first time, I can open it with any amount of money that I have saved.
So all you need to open a Roth IRA is you need to have like a job. So you need to have earned income. But like if you have a job, you're making like $50,000 a year and you've got like $10,000 saved in cash, like in a bank account, you can open up a Roth IRA and max it out, put that $6,000 in immediately, and you're not going to have any issues.
Okay. Also, it has to do with the amount I put is with the basically like with the amount I report. Like, let's say I have more than what I make a year. So this money I have saved over a long time. Like,
no, it has to do with your earned income. So it's not going to take into account your however much you have saved over time. There are limits, income limits though, on Roth IRAs. So if you essentially make, what is it? Roth income.
So the first time I open it has to do with my income.
Yes. Are you working right now?
Yes.
Okay. Yeah, you'll be fine. Cause when you open it, they'll ask you like, what's your employer, like, what's the pay, how much money do you make, like a pay range and things like that, just to verify that you have earned income. So that's where you'll essentially report it.
And it doesn't matter if what I'm trying to deposit is like a lot more of several years of income. It doesn't matter, right? They won't ask me like, I don't know if you understand me. Like, let's say I make, let me see, 100,000 a year, but I want to deposit 300,000. Like,
yeah. Okay. I get what you're saying. No. So you're only allowed to put in $6,000 a year into your Roth IRA.
Okay. But even when it's opening the initial.
Yep. So if you were to open it right now, right, on February 11th.
Okay.
Still can contribute the $6,000 from 2020 because you have until April 15th of this year to max out your 2020 Roth. And you can contribute that $6,000 for 2021. So you technically, for your individual situation, if you have that much money, you can invest $12,000 essentially right now into your Roth IRA. But every year, these income limits, they don't always increase, but they essentially I think it's October, November, they'll give you the limits for the next year, how much you can put in, but there's definitely a cap on how much you can put in a Roth IRA.
Okay. All right. Thank you, sir.
Yeah.
One more quick question for you. So you have to put down your employer information, but if you're like self-employed or 1099, then you just put yourself.
Yeah. So you'll just put whatever your business name, whatever the address is, and you'll put that in there. I haven't seen any situation where someone has inserted like their small business information and it's gotten kicked back. You might have to fill out more paperwork if they need to do like extra verification, but yeah, you would just input your business's information.
Thank you.
Yeah.
Bye.
Okay. So I got to wrap it up, guys. I appreciate you all being on. I hope this this presentation tonight was helpful for you all. I'm happy you guys were able to catch this a second time around, and I was able to record it this time. So thank you guys again. Feel free to DM me. Like I said, I still got a couple more copies at 20% off for the index fund book. I think 4 people bought it during this time. So we're at, about. So everybody have a good night, and I appreciate you guys again.
Thank you.
Thank you. Excellent class.
Thank you.
Gang, gang.